Today I want to talk bottlenecks, and I want to talk about a bottleneck when it comes to scaling a successful restoration company.
I built this business around my family, not the other way around, for the freedom to be able to go and enjoy that. And that's a huge philosophy of why Blue Sky exists. Is part of our mission is to help owners get back some of their own time and financial freedom by understanding how to use the systems that are out there. So
You mean more money doesn't solve more lines of credit and more money doesn't solve every problem for a business?
the standardization, the deviation of the statistics state that people in this industry tend to fail at a higher rate, right? It just is what it is.
It's really building a business that allows you the freedom and the flexibility to pursue any growth that you want through securing capital.
Why wouldn't you build out a strong foundation where you have access to both? And now you have leverage and control over where you go, when you go, and why you're going there.
I love that.
Welcome to the Restoration Pros Unplugged podcast. In each episode, we're going to bring you insightful interviews and discussions with top restoration industry leaders. We're also going to delve into their business, the strategies that made them successful, and most importantly, the valuable lessons they've learned along the way. I'm your host, Clinton James. I'm also the Chief Marketing Officer at Water Restoration Marketing. We're a digital marketing agency dedicated to helping restoration companies nationwide secure more high-value water jobs. Now, this show, it aims to provide you with the knowledge and tools you need to excel in the restoration industry. So sit back, relax, and enjoy the show.
And welcome everybody to another episode of the Restoration Pros Unplugged podcast. As always, I am your host, Clinton James. I'm also the Chief Marketing Officer over at Water Restoration Marketing. Today I want to talk bottlenecks, and I want to talk about a bottleneck when it comes to scaling a successful restoration company. So we work with over 130 restoration companies across the country, and a lot of the most successful restorers, right? They're doing strong revenue. I'm talking about multi-seven figures a year and even eight figures. A lot of those guys feel cash strapped. It's really not an issue of performance either. They're going out, they're selling the jobs, they're doing the work, they're exercising great margins there. They're really missing a structure, right? And those businesses, those restorers, they want to take back financial control over their business and make sure they have the resources and they're properly capitalized to take advantage of the next opportunity. Right. And to have that conversation, I brought on today's guest, Paul Childers. Paul is the founder of Blue Sky Business Solutions. So welcome to the Restoration Pros Unplugged podcast, Paul.
Yeah, thanks, Clinton. I appreciate you having me on. I'm looking forward to being able to share some knowledge, some experience, and hopefully help some guys, resolve a situation if they're stuck in it.
I love that. Before we get too deep into the conversation, Paul, why don't you give the audience a little background on yourself, Blue Sky Business Solutions, and really how you started working with restorers?
Yeah. Background on myself. I am married to a farmer's daughter. So I live in very rural America. We live in a town of about 1,400 people. If you aren't seeing me in the spring or the fall too often, it's probably because I'm out in a tractor helping. Got two kids. My wife and I will be married going on 17 years. So, I built this business around my family, not the other way around, for the freedom to be able to go and enjoy that. And that's a huge philosophy of why Blue Sky exists. Is part of our mission is to help owners get back some of their own time and financial freedom by understanding how to use the systems that are out there. So that's a little bit about myself. I come from automotive. We've done EIN only financing through the dealership that I worked at. I've been an executive and helped run and grow, large companies. I was with an egg and construction tire company that went from 16.5 to 45 million, 48 million in 2 years. So I've seen growth. I've seen constraints. And honestly, a lot of times the issues really aren't solved through accessing debt. It's a weird thing to say, I know.
You mean more money doesn't solve more lines of credit and more money doesn't solve every problem for a business?
That'd be awesome if it did, but a lot of times it actually compounds the issues even more and makes it that much harder to get out.
Okay. Well, when Paul would obviously tell us a little bit about your first experience working with restorers.
Yeah. So, restoration companies are fascinating to me, kind of like roofing. Companies were very fascinating to me because roofing was my first client.
Okay.
I had a large roofer in Texas that had all of his vehicles tied to himself personally. He was trying to get a loan for a new home that he was trying to build. And he's like, my mortgage company keeps telling me my debt to income's too high. He's like, my balance sheet and financials on my business are fantastic, but I don't really pay myself. Super common story, right? Like we all know that we pay ourselves the bare minimum because there's that tax line we've got to straddle.
Trying to reduce our personal tax liabilities. I understand that.
It's a game. But so, in helping roofing, and kind of where I'm going with this is a lot of it's reliant on insurance. And now roofing's, I think, a few years ahead of where restoration is right now, where they're starting to really go and shift to retail, and a lot of them are. But insurance brings with it a very interesting caveat to it, in which you literally have zero control over how fast you guys get paid out on money. There's some things we can do, but until the insurance company signs off and releases it, when are you going to get cash?
That's true.
And the flip side of the problem with, like in roofing, is banks really don't like accounts receivable that's tied to insurance, for the exact reason that we don't really know what you're going to get. You might say that you have 120,000 that's due, but is that what the actual payout's going to be for the insurance company? Because you and I both know, and these restoration owners and roofing owners both know, that the insurance company's only objective is to reduce the amount of money that they're going to end up paying out. So they're doing everything they can to fight against those quotes and those estimates. So how do you solve that problem? Right? I mean, that's really kind of what got me into this whole thing. Was we started to look at roofers and go, oh, a lot of the issues is there's not a lot of clarity around their business. Right. And then when I started getting into restoration, I started noticing the same issues. There's not really a lot of clarity around the actual business structure. Your business doesn't show up how you think it shows up. You might look like a $8 million a year company, but financials and the details on your company and the credit reports on your company and the debt servicing on your company shows that you're really maybe like a $800,000 a year company.
Oh, wow. Okay. There's a little bit of a disconnect there.
So that's kind of my first, experience with restorations. Is there's a lot of correlations between roofing, and we've had a lot of success helping roofers get lines of credit, increase their capital access on credit cards, finance all of their vehicles for their sales teams. If they have the full, start to finish crews, all of the equipment, everything that goes along with it, getting that all under the business. But it started with all of the little details. And we're seeing that with restoration companies, because I will say one thing the restoration business and world does differently than roofing is they blow up a lot faster. And a lot of it's W-2 driven. Roofers will blow up, but most of it's 1099.
Right.
So there's a very unique difference there, because as a W-2 driven company, you actually have more leverage and more advantages in the lending space than you do if you're running everything 1099.
Well, we'll talk a little bit about how lenders potentially evaluate restoration companies. But I've had a lot of conversations with really, really successful restoration companies. I've heard you use the term building the business behind the work. What does that actually mean for a restoration company doing, let's say, $3 to $10 million a year in revenue?
Yep. So when we talk about that, and I talk about how do you show up, I always talk about, we all think our financials are pretty clean, especially if we're working with a CPA or a bookkeeper, right? But my whole thing is, how complicated and how easily can you articulate your own financials? Can you explain to me what's going on in your business behind the scenes? Because if you, the owner, cannot explain to me what's all happening, why it's happening, where things are going and why they're going there, then we have a problem. Because chances are an underwriter at a bank is not going to be able to articulate that either. So there's that piece of it. Is your bookkeeper, is your CPA, is your CFO simplifying this to the point that you, the owner, can explain it to me in very simple, easy terms, right? That's phase one. Phase two then is, how long have you been in business and how many times have you changed locations, right? What's your address listed as on your Secretary of State report? What is it on the IRS? What does it show up on your Google My Business profile? Here's one of the funny things that I see with marketing that I understand why we do it, but there's cause and correlation. We'll put a Google My Business profile address in a different location from where the business actually is located.
Sure. We do it all the time.
Totally makes sense. If you already have too many strikes against you in the lending side for fraud, and then there is a disconnect from your Google business profile showing you 30 miles away from where you're actually located, or even 15 miles away from where you're actually located, you get another fraud flag because it's not lining up with all the details on your company.
Wow.
Now, that doesn't mean that you're going to automatically default, but if everything else in sequence before that is not aligned, we've just struck out before you ever got put in front of an actual underwriter to know what we get approval for. So what does that mean? Well, we look at that all that stuff. What shows up on your website? What's the address on there? What's the address on the business bureaus? What's the address on your bank account? What's the address on your credit cards, your supplier accounts, your Secretary of State, your IRS docs? If those are all in alignment, then we can maybe survive a strike against us for Google My Business profile being somewhere else. But if all of those other things are out of alignment, and then we get the strike on the Google My Business when they do an underwrite on you, we may not survive, and we might have too many X's against us, right?
I've really never considered that. I mean, I have a digital marketing agency, and we encourage the restoration companies that we own, if they've got a large service area, to keep a primary Google business profile that's associated with their actual location, but to go out and set up these satellite offices, right? So that we can get those ranked and they get plenty of organic opportunities through the maps of Google. Is that a strategy that you would advise against from a financial standpoint?
Not at all. I think it's a strategy that as long as it's aligned with the overall picture of the company, it's not a problem, right? Because if we can explain what's going on, hey, I've got my headquarters, and this is where a lot of owners mess up when they have multi-locations or they're expanding. I've got my headquarters, but we didn't call it out that this is the main brain of the operations.
Okay.
And now all of a sudden you have all these fragmented addresses and locations and all this stuff showing up and credit flowing through one, flowing through another, instead of it all flowing through one spot.
Okay.
Right. That's when it creates these types of issues. If you're a solo location, a lot of times it's because you haven't updated your address in the last like 6 years and you've moved 4 times. Right.
Mm-hmm.
So it's just controlling that presence.
Okay.
Now, you'll appreciate this. Does your website look professional? Does it accurately represent what you're doing? If you're not actually going in and dealing with, I see this a lot with restoration where they'll have like, not necessarily like, crime scene stuff, on their sites, but it will kind of hint at it. And I'm like, okay, hold up. Do you actually deal with bio stuff like that? And a lot of times you're like, no, we're not certified to do that. Then I'm like, get that off of your website immediately.
Okay.
Because if a lender looks at that and they see that, and you don't actually do that, you're getting yourself put into a different risk category than you should be.
Okay.
Right. So it's these little details all matter, and people I don't think owners really understand how much they matter.
Do lenders really judge restoration companies based on their online presence? Because I trust me, I'm like the biggest champion of making sure that you've got a website that really does a good job of representing you and the size of business that you are. But does a lender go out there and look at a client's website? It looks like it was built 20 years ago, and sure, they claim they do $5, $6, $7, $8 million a year, but that's not the business that I see online.
Yep. Yeah, you absolutely. And it's not even necessarily the lenders themselves. It's the databases that they're using to pull all of this information on you and score you out, right? It's LexisNexis, it's credit safe bureaus, it's the individual business bureaus. Banks and lenders have access to all of this information, and it pulls together this big profile on you. And depending on the type of loan that you're doing, you absolutely better believe that they're going in and looking at the character of the company. They're going onto your Facebook profiles and they're looking at what you post, how you act, what do you do, because they're looking at this as more of a risk mitigation partnership type of a deal, and less of a, is this a person of character that I want to lend to? That's kind of the phrase in the lens that they're looking through. Like, we're extending you our capital. Are you going to be a good representation of us if somebody sees that you bank with us and you're out in the public? Or are there risks here that we need to, be aware of as well? And then the other part of that is, are you really doing what you say you're doing? Right. And that's where they go and verify this, because let's be honest, fraud is rampant in the world that we live in today.
Sure.
And it's very easy to set up a website that says I'm a coaching and consultant, but in reality, I'm actually doing high risk business activities like selling cannabis out of my house or something, right? Like, just from right? But so absolutely, they are taking all of that stuff into consideration every time they look at deals.
Okay. A lot of restorers go out and they bootstrap their business initially, first year, 2 years, 3 years. And in order to bootstrap the business, they take on some personal lines of credit. So where does personal credit become like a real risk when it comes to growth for a restoration company?
Yeah, I mean, let's talk about, where those lines of credit are coming from, right? I mean, are we taking lines of credit against our homes? Are we just taking a personal line out on our own side, through a credit union, like a working capital line or what? I always rank it in tiers of what is the money being used for, where is it coming from, and what is it getting secured against, right? The very last thing I tell owners to secure loans against is their home. Because at the end of the day, if things go wrong and you lose your home, you've now lost ground zero and you're literally starting over from probably living out of your car, right? Uh, so time and place. Where's that loan going? Is it going to just float an expansion? Are you using it to pay down a tax lien that's potentially getting laid against you? Right?
Yeah.
We've used HELOCs before to mitigate the tax liens, because if you get a tax lien laid against you, everything stops. I don't know if you've ever experienced that or had people who have. They're nasty.
Knock on wood.
So what's the exposure, right? Don't take a HELOC out to go do an expansion on your fleet. That's dumb, because now you have vehicles that employees are driving that are out on the road that could be getting hit. I don't care if you have an umbrella policy or not, right? The wrong person at the wrong time with the right access to the right attorneys is going to rip everything away from you when that correlation and that connection is there, right? So there's time and place for those types of loans in general, right?
Yeah.
When does it start to become really risky? As you grow and you start adding employees, because now you add more potential exposure to risk through accidents, work comp, anything like, claims with customers. It just kind of stacks and compounds. That's where we really like to work off as much stuff that's directly tied to you personally. Personal guarantees on loans that don't show up on personal credit aren't as bad of a thing.
Okay.
It's the loans that literally draw and connect a line directly to you, the owner, on your credit report. That's when they become a problem.
Okay, good to know. I know there's probably a lot of restoration owners that are listening to this that are like, hey, I've got a CPA, I've got an accountant, I've got a fractional CFO that I use in our business. Isn't this in their peripheral? Isn't this something that they should be able to advise me on?
Yeah, they're not bankers. They're not lenders. They maybe have a base understanding of underwriting, but they don't have a full understanding of underwriting. They don't have a full understanding of risk indexes that are being looked at. They're not specialized in this place, and they shouldn't be, right? Just because they get your financials prepped and in order and say, hey, you're ready to go to a bank, doesn't necessarily mean that they know what bank you should be going to.
Okay.
It doesn't necessarily mean that they understand the order of sequencing of working capital, lines of credit, factoring, progress funding, equipment loans, and how those potentially collateralize against your company and function, right? Like, one of the most common things I hear as I work with clients is, man, I've had a CPA. I've had a really good relationship with my local banker. I've got a CFO that's got everything. Nobody's ever shown me that this type of thing is possible until you came along.
Yeah, I kind of want to dive into that a little deeper, right? So we've got accountants that are optimizing the books for A, right? How does that differ from what a lender's looking at when they're evaluating you for some kind of capital?
So think about the overall strategy of what that accountant, tax strategist, the CFO is trying to do, right?
Minimize tax liabilities.
Exactly, right? So a lot of times they're looking at this of how do we reduce as much stated income as possible to have you help pay the least amount of taxes as possible. And the unfortunate part about that is a lot of them do the very minimum of actually like thinking ahead and really strategizing. They take the shortcut, which is we're just going to write everything down and show as little as possible. But what they're not doing is communicating with you, the owner, the right way, where you're going, hey, I need to buy a commercial property this next year because we need to expand. Well, they write everything down. It shows that you're not making any money or making very, very little money. And then when you walk into the bank to go, I need this commercial real estate property, and they say, hey, show me the last 2 years of your tax returns, and your net income over those last couple of years is like under 30K, they go, oh, well, we can't fund this deal. You don't have
Okay.
you don't have the potential to do that.
Okay.
So where we come in is go, let's communicate with these guys. We need to show profit for the next 2 years. You're planning to do a $3.5 million expansion here in year 3. So we need to have 2 years of tax returns that show this amount of profit so that we can carry this debt.
Okay. Where do you ever find yourself kind of like butting heads with a CFO, an accountant, like the bookkeeper in one of your clients' businesses?
No, not really. In fact, I actually at first I did, because I think a lot of them thought that I was coming for their jobs. And in some cases, absolutely. If we get in and we see repeated issues or an unwillingness to change, I'm like, okay, we got to go find a CPA that's willing to actually do this the way that they need to do it.
Okay.
But that's not common. I actually like really good high level CPAs, bookkeepers, CFOs, because they do the stuff that I don't enjoy doing. All the little data, like data work and detailed work. They provide all the forecasting. They provide all the metrics that we use then to kind of put the rest of the puzzle together and go, okay, this is good. We can go take this to this lender, and this is what your approval should be based off of this. So sometimes, sure, if there's an unwillingness to kind of like think outside the box a little bit in what's the client's best interest. But I usually leave that up to the client, and I'm like, you got to have this conversation with them, not me.
Fair enough. Speaking of fractional CFOs and bookkeepers, a mutual friend of ours, Nicole McKenzie, and the team over at Momentum, she's actually the one that made the introduction. We won't spend too much time in it, but if you're looking for a good bookkeeper, fractional CFO, the team over at Momentum, I would say is top tier. They work with a number of our clients. I'm sure you've got some workings with those folks as well. All right, so let's talk a little bit about lenders' perspective, right? What are lenders actually looking at most when it comes to restoration owners that the business owner, the operator, just doesn't understand, or maybe they misunderstand it?
Yeah. So it's the funny part is I was at an event, a conference event, actually Evolve Restoration Mastermind Group with Alex Duda and Matt Balducci, and they were talking about how businesses, like, we overcomplicate things, right? We think our business is special. 95% of business is all the same. It's the 5% at the end that's different and unique, typically, right?
Mm-hmm.
So that applies to lending a lot as well. 95% of it is all the same. Like, can we understand what's actually going on in your company, and does it make sense? Can you articulate that to us? Can you articulate the usage of the money to us? How are you going to repay it? And when you tell us that, do your books, do the number of accounts that you have, does your accounts receivable, do your assets to your liabilities, your equity on your balance sheet add up to what you're saying? And are you already over leveraged in any other form of debt? Are you able to service this debt? Right. So they look at a lot of that stuff. Where we draw a line is we don't really let lenders look at anything on the personal side where we can avoid it, right? Because really, your business is your business. If it can carry on its own, it should be able to carry on its own regardless of what's going on in your personal life, right? Like, quite frankly, that's what I can't remember what constitutional right that is on the business side, but the U.S. government recognizes our entities as a individual, right? So it has essentially all the rights of an individual person. So why do we let banks infringe on that independence? We shouldn't.
And they do it all the time, though.
All the time. All the time. Right? But it's because they can't tell your business's capabilities to stand alone because you've never done it and clarified that, right? I mean, that's a lot of it. And you've never known how to ask or push back. So they look at all of that in that standard. And then they also look at your industry. Are you a high risk industry? Sometimes we can't avoid the fact that we operate in high risk industries where just the standardization, the deviation of the statistics state that people in this industry tend to fail at a higher rate, right? It just is what it is.
Do restorers and home service businesses fall into that category?
They fall into like a mid-range.
Okay.
Right. Now, restorers that fall into stuff where they're dealing with, so look at it this way. So if you're dealing with human remains, right?
Biohazard.
And you're dealing with mold and you're dealing with kind of all these other things, like things that can open you up to liabilities that aren't available to other people in your industry, right? Where you can get sued because you came in and you didn't maybe gently handle the situation right, and
Yep.
you cause an issue. Now you're getting sued from that homeowner, right? Like, what's your exposure to additional outside risks? That's kind of one of the things that they're looking at. What does your credit history look like? Does your business have any credit history? How well do you pay your vendors? How timely do you pay your credit cards? How timely do you pay all of your bills? Do you have any repossessions on your trucks? Have you missed payments lately? Right? Have you had a string of late payments? So it's similar to personal credit in that regard, but it's on our business. But if they don't have that portfolio or that file to look at on the business, they're always going to go and fall over onto the personal side.
Okay.
Right. So that's why I always say, let's build this up first. So that categorically is kind of like what they're looking at, is like, really at the end of the day is like, how capable are you of actually servicing this amount? And what is the aggregated risk exposure over kind of everything?
Okay.
Right. Like, that's why I tell people, if you don't build a business clean and you're commingling stuff, well, now you're pulling in everything that you're commingling into the risk picture.
Okay, that makes sense. Now, how much does an approval come down to, like the actual numbers, right? When they do their due diligence versus the way a business is presented to a lender, right? And what does a lender package look like?
So yeah, those are great questions. At the end of the day, this is all part of how you show up, right? I mean, it's all tied together. Do you have a good insurance plan? Do you have workman's comp coverage? Do you have benefits? Do you have payroll coverage? Do you have all these little things categorically in place that make your business look like a legitimate business, act like a legitimate business, and feel like a legitimate business, right?
Mhm.
Do you have a lot of deposits coming in, or are you only getting deposits coming in from one or two clients consistently, right? I'll tell you right now, if you've got more than 20 clients that pay you every month, that's better, right? So if you've got two insurance companies that you do the majority of your stuff through, I would recommend spreading out your deposits so that it shows more than just two a month.
Diversification. Got it.
Right. So that's part of it, right? The other part of it is simply just, do they want to lend to you? Right? Think about when we talk about a lending package, right? Think about all of the business owners that are walking through their doors every day. Sit down at their desk and go, I need a loan. And the lender goes, well, what do you need a loan for? And that owner's like, truck. I need a line of credit. Okay, for what? Just to have. But when you go in there and you've got your financials clearly presented, you can articulate them. You've got a little biography on yourself. You've got a capital request needs, like, this is what we're using the capital for. Here's where it's going. Here's how we plan to pay this back over time. Here's how we plan to manage this, right? You've just now separated yourself from every other business that's come across their desk. So now you become intriguing to them. And when you become intriguing to a lender, they're usually willing to dig a little deeper on your case file and fight a little bit harder to get you into that underwriter and fight on your side, versus just kind of tossing you off to the side and go, they didn't pass our automatic underwriting, so I'm not going to bother anymore.
That makes sense. How do you and Blue Sky Business Solutions fit into this equation with the services that you guys offer?
Yeah, so a lot of it is, we do a done with you service, right? So a lot of the stuff that we used to be able to do in our done for you got taken away from us when bureaus and lenders started to crack down on fraud. So we just took all the processes that we had in that time period. How do you update your bureaus? How do you file disputes? How do you update all of your data and information on all these different sites and areas? And we built them into a nice little package in our done with you, where we're like partners. We're right there with you. We walk you through all this stuff. But we take all of these fragmented pieces of your business that you probably never thought of, right? Because a lot of times, like, your insurance agent's doing one thing, your lawyer's doing one thing, your CPA is doing one thing. Hopefully your CFO and your CPA are in alignment, but I can tell you, I've come across plenty that aren't. And then we take all of that stuff and we put that all together and go, here, comprehensively, this is what we're dealing with. Here's where you're going. Here's what this should look like. You might want to have these three people talk to each other one time and make sure that they get this stuff in alignment, right? So we parse all of that information together. And then the other part of what we do is, whether it's going to a local bank or to a national bank or to an alternative or going to a family office or a private investor, we know exactly what they're looking at and how they're looking at it. Let's help you put this together in a way that we know, at least at a minimum, you're going to get a serious consideration on this package that you're asking for.
Okay.
Right. In some cases, I can already tell somebody based off of their financials and their credit scores on the business and all that kind of stuff. Like, if we go apply for Ford, you're probably going to get somewhere between a $425,000 and a $475,000 line offered to you.
Mhm.
Right. So some of it, I just know well enough now that I can just look at it and be like, yep, you're going to get approved. Here's what you should be getting approved for.
Okay.
So that's how we kind of partner with the owners and assist with this. And then also building out their business credit. Like, how do you build business credit? How do you get to actual meaningful credit? Right? Because a lot of people hear business credit and they're like, oh, I don't need a $15,000 Costco card. I don't need a $100,000 Home Depot card. Maybe we do. I mean, some guys need good Home Depot stuff.
Sure.
I want a line of credit that's not secured. I want to get access to vehicles. I want to be able to buy properties without having to use my personal. Well, that takes a process. Yes, we have to have the store credits. We need to have at least 12 of these things reporting on our account in order for us to get to the decent loans that you guys want to get to. Well, how do we get there, and how do we use meaningful debt to get there that doesn't over leverage you or cause you to go backwards? That's a process. It's shifting how we do expenses. It's changing how you think, and it's understanding the importance of diversification of funds.
Is that what you mean when you talk about capital stacking?
Yes and no.
Okay.
It is, in a sense of, when people talk about capital stacking in the traditional sense, they're talking usually about, like, you get a line of credit first. Then what can you roll on top of that? Can we do an SBA? Can we do a commercial property? Where does factoring fall into this? Where does project funding fall into this? And that's part of it, because you have to understand the sequencing of how do we add these, funds on top of each other. Business credit kind of falls into that category a little bit, but for me, more so, it's the access to capacity, right? It's not necessarily that we're just plopping all this capital on top of you at one time. Like, capital stacking really is like, how do I just go and plop all this capital and debt onto me at one time and then have access to all of it at once? We're more about, how do we increase your capacity so that by the time we get to where you need to go, we've already got these approvals in place and you have everything you can just plug and play and run with it, right? I don't always like to capital stack, because that can over leverage you really fast and put you into a backward situation.
Okay. So if I'm a restorer right now and I'm considering maybe buying the commercial space that I'm in right now, or maybe I'm looking at going from having 2 service vehicles to adding 2, 3, 4 additional service vehicles. So I have it in my mind, like, this is what the goal is for the business. And they reach out to you. Not only are you going to help take a look at their books and make sure that they present themselves well to lenders, but you've been doing this long enough to where you can encourage them, hey, these are the specific lenders that you should go to, not just for the best terms, but for the highest likelihood that they're going to get an approval.
Yep.
Okay.
Yeah, and we're going to look at your credit score too on your business, right? Because the reason why every road that we go down leads to business credit in a lot of ways, but business credit isn't always used in every scenario, is because the lack of not having a high quality business credit score across all 3 bureaus is what keeps doors locked to different funding devices. And if you don't have the business or commercial credit scores to unlock those doors, you're never going to have those conversations. I don't care how clean you think you are.
Okay. So even if they don't have that purchase immediately on the horizon in the next 3, 6, 12 months, it still would be in their best interest to get all of those ducks in the row and use a firm like yours to make sure that they're doing things the right way and building that business credit. So when the opportunity comes for them, whether it's expansion, whether it's commercial purchase or commercial building space purchases, whatever it is, they're in the best position to potentially go out and get the capital that they need to make that investment.
Right.
Okay.
Yeah.
Now, you've done this for a while, and I know you shared with me kind of a recent restoration company that you worked with in California, here where I live now. Can you tell us a little bit about, like, what was the biggest misconception that restoration company had when they first came and looked at working with you?
Yeah, so I think that, and this is not just restoration only, right? This is I think this is owners across the board. We tend to trust too fully in our current relationships, right? One of their biggest hurdles that we had to get them by was, yes, I understand you appreciate your local bank. I know you have a good relationship. You go out to lunch with your banker, they care for you, they take care of you, all that kind of stuff, right?
Sure.
But at the end of the day, are you too tight with them? Do they have too much with you, right? And then are they big enough to scale with you? Are they actually separating out these loans? They might say they are, but go in and ask them to fund a new home and see what they say. And I guarantee you're going to run into, oh, your debt to income is too high. We can't do this.
Okay.
So that's a lot of the misconception is, well, I've already got a relationship with my local bank. We fund all of our vehicles through them. We've got a line of credit with them. And that's automatically a red flag to me. I'm like, you guys are going to get stuck and you're going to hit a wall so hard, it's going to catch you off guard.
Okay.
So let's start untangling this now. The other one is, well, I've got good personal credit, so why does it matter? And the kind of example I always give everybody is like, have you ever seen a bodybuilder that only works out the right side of their body?
That would look awkward.
Right? So why are we doing that with our business where we're only ever lifting with personal credit when we have all of this other capacity over here with our business credit to carry stuff? Why wouldn't you build out a strong foundation where you have access to both? And now you have leverage and control over where you go, when you go, and why you're going there.
I love that.
Right.
It
So
sounds like
those
these
are-
oh, sorry, I didn't mean to
No,
cut
go
you.
ahead. You're good.
I was saying it sounds like these strategies are really not built necessarily only for today's capital needs, right? It's really building a business that allows you the freedom and the flexibility to pursue any growth that you want through securing capital there. And it sounds like that's kind of where your business works. This company in California, how big were they? How much revenue?
They were, when we started working with them, they were about 4.5.
Okay.
Right.
What did that, I'm sorry, go ahead.
No, go ahead.
I was gonna say, what did the process look like? First of all, why did they come to you? Were they looking for a specific line of credit to make a purchase, or what were the scenario?
Yep. They were, so a couple of things. One was they were using a Capital One Sparks card that was tied to their personal, and they kind of knew it, but they didn't really know it at the time.
Okay.
Because they were like, my personal credit like fluctuates a ton. Like it's like one time in a month it'll be like a 650, and then all of a sudden the next time in a month I'm like a 720, and I don't understand why it's always going up and down. And to me, I'm always like, what card are you using? Because I can almost guarantee you're hitting your over your utilization numbers, and you're not paying it down, or you mistime the pay down and it's slapping your personal credit, and you're just on this roller coaster.
Okay.
And they're like, well, we're 4.5 mil, but we only have access to like $15,000, $20,000. They just bumped us to. They're like, we're paying this card off like 32 times a month. And I'm like, well, that's weird. That shouldn't be happening. What's your line of credit look like? Oh, our bank gave us a $75,000 line of credit. Also weird. Okay. How long have you been with that bank? Oh, we've been with them since we've opened. We've been open for 5 years. Wow. Like, have you guys ever gotten behind on any payments or anything? No, we pay that line of credit and this credit card off constantly. So then to me, I'm always going, okay, we're with the wrong lenders. We're using the wrong cards. And then the other part of this is your business is not accurately reflecting what you are actually doing. So we need to fix some things. We need to fix the beat. Sometimes, honestly, we'll go in and we'll just clean up all the details, the addresses, and the SIC code, NISC code, all of that stuff on the back end. And as soon as we get that all updated, I'll go, okay, we're not going to do Capital One, but go apply for Chase, go apply for US Bank, go apply for Amex Plum, Blue Card, whatever, Bank of America. And it's like a whole new world opens up to me. Like, oh, I just got an approval for like $100,000 on this card. I'm like, I know, like this is so common. So that's kind of the first thing. And the first thing I listened for, what they came to me for was they just didn't have that. They're $4.5 million a year company. You cannot tell me that the capital amounts that you have between your credit card and a line of credit barely going over $100,000 is nearly enough for you to be functioning off of, right? Yeah, they had some supplier accounts, but supplier accounts you have to treat like partnerships. Credit cards and lines of credit are to treat like, oh, we're in a bind. Let's get our suppliers paid down so we don't hit a wall. Well, if you don't have the capacity to pay your suppliers down with a line of credit and your credit cards, well, you're kind of screwed.
Right.
So that was their initial thing. And that's always the first thing I ask about. Tell me about how your credit flows. Tell me about your access to capital right now. And usually from how they answer me, I can pretty much pin what the issue is and what we need to do.
I like that. So if you're a restorer right now, and you some of this message kind of resonates with you, hey, you're using personal cards, you don't have established lines of credit for your business. Paul, tell the audience how they can reach out to you and the team over at Blue Sky.
For sure. We got our website, blueskybusinesssolutions.com.
Okay.
Or you can follow me on Facebook. It's just my name, Paul Childers. I have my own profile there. We also have our Blue Sky Business Solutions profile there. You can DM us. We have a form on our website that you can fill out and it will go right to us. Those are the two easiest ways to reach out and set up. We do a full free 30-minute discovery. I don't charge for that because I want you to see what's out there.
I love that. If you're listening and you're driving right now, don't worry. We're going to put Paul's contact information in the show notes or the YouTube description there. Paul, before we let you go today, any like words of advice for that, let's say, new restoration company that really hasn't put in the structures, hasn't started to even utilize business credit yet? What should they be doing to set themselves up for success?
Yep. First and foremost is if you're going to set up and you're going to be planning to be a growing business, just skip setting yourself up as a sole proprietorship, go straight to an LLC, set yourself up properly. When you get your EIN number, go on to Duns & Bradstreet, apply for a Duns & Bradstreet number. It's free. And then the best thing you can do is you can go and set up a NAB Prime account, right? And that will get you access. And they even have on their site, yeah, they're maybe a little bit of a competitor of ours in some sense of the word, but they'll have all of this first tier credit accounts that you can get. I always tell new businesses, like, you're out driving a lot, go grab a fuel card and get that reporting right away.
Right.
If you have good credit, don't start off with a crappy credit card that's going to just not do anything for you or set you behind. Start out with a credit card that reports. Your Chase Inc., anything that's revolving that gives you a credit limit. If it doesn't give you a true credit limit and it says unlimited, don't take that unless you need to as a secondary card. Right? Because that won't report to the bureaus. Revolving cards do. Right?
I know the audience like, wait, what about my American Express card? It doesn't have a limit to it, Paul.
I hate to break it to you, it doesn't report. Now, that doesn't mean you should stop using it, but just know that it doesn't report and we need to have other carbs and access to capital it does.
Awesome. Paul, I really appreciate you coming by, sharing a great deal of knowledge. Again, let the audience know one more time, what's the best way to reach out to you and the team?
Yep, blueskybusinesssolutions.com. You can fill out our form for a free discovery. Otherwise, you can hit me up on my Facebook page, just Paul Childers.
All right, we'll make sure we drop all that in the show notes. And to the audience, thanks you guys for sticking around. I hope you got a lot of value, and I hope you recognize when it comes to growing a successful business, yes, your numbers have to be in order. You have to do good business, exercise good margins, make sure that you got plenty of new work coming in, but you got to have the back of the house in order for you to have the opportunity to leverage the capital that's out there to grow your business. So thank you again, Paul. We appreciate you stopping by the Restoration Pros Unplugged podcast this week.
Thank you.
Thank you for listening to the Restoration Pros Unplugged podcast. If you like what you heard today, be sure to subscribe, share, and also leave us a 5-star review. We'll be back with more interviews and discussions with restoration industry leaders really soon. In the meantime, if you're a restoration company looking to add more high-value water jobs, you can reach me and my team at waterrestorationmarketing.net. Again, that's waterrestorationmarketing.net. I look forward to hearing from you soon.